Picture this. You're a tech startup founder, and suddenly your entire company's cash reserves vanish overnight. Sounds like a nightmare, right? Well, for thousands of businesses. This became a shocking reality in March 2023. Welcome to the Economy Unpacked Daily YouTube channel. From Wall Street to your street, we share the world of money in a clear way. The collapse of Silicon Valley Bank sent shockwaves through the financial world, becoming the largest U.S. bank failure since 2008. SVB's downfall hit an entire ecosystem of innovation, creating ripple effects across the global financial system. But perhaps more surprising was how this event reminded us that bank runs, something many assumed were relics of the Great Depression, can still destabilize banks in a matter of hours, even in our digital age. So, what exactly happened at Silicon Valley Bank? Unlike typical retail banks, SVB served a unique niche: startups, venture capitalists, and tech companies. This concentration of high-value but volatile clients made its deposit base inherently riskier. During the tech boom of 2020 to 2021, SVB's deposits skyrocketed. But when the tech sector cooled off and withdrawals began, the bank found itself in a precarious position. Adding fuel to the fire, SVB had invested heavily in long-term government bonds when interest rates were near zero. As rates rose sharply, the value of these bonds plummeted, creating massive paper losses. These losses would become very real if SVB had to sell the bonds to cover withdrawals, which is exactly what happened. To understand why this spiraled so quickly, we need to grasp the mechanics of a bank run. Banks operate on a fractional reserve system, meaning they don't keep all deposits in cash. Instead, they lend most of it out or invest in assets, holding only a fraction as reserves. This system works fine under normal circumstances, but it can unravel quickly when fear takes hold. Even if a bank's assets exceed its liabilities on paper, it can still fail if depositors demand their money faster than the bank can liquidate those assets. SVB was technically solvent, but became illiquid when withdrawals surged. Once people fear losing access to their money, the rational choice is to withdraw immediately, creating a self-fulfilling crisis. The Federal Reserve's aggressive interest rate hikes to fight inflation played a crucial role in SVB's demise. For SVB, this meant their bond investments lost significant value, locking in massive, unrealized losses. Poor risk management worsened the situation. While other banks diversified or used derivatives to hedge against interest rate risk, SVB left itself exposed to the worst-case scenario. Unlike in past crises, social media and group chats allowed fear to propagate in real time. Startups and VCs rushed to withdraw funds, coordinating their actions instantly. The result? A staggering $42 billion withdrawn in just 24 hours, making SVB. The fallout was immediate and far-reaching. Regulators stepped in quickly to protect depositors and prevent contagion, but equity and bondholders were wiped out. Many startups suddenly lost access to cash for operations and payroll, creating panic in the tech industry. Fears of spillover effects hit regional banks in global markets as investors worried that other mid-sized banks with similar exposures could also fail. So why do bank runs still exist in 2023? The answer lies in the very foundation of banking: trust and confidence. Lose that trust, and a bank run becomes inevitable. Even the strongest bank cannot return all deposits at once. The fractional reserve model inherently depends on depositor confidence. Moreover, finance isn't just about numbers, it's also about emotions. Fear spreads faster than facts, and once panic starts, it's incredibly difficult to stop. The psychology of fear in finance can override rational decision-making, leading to self-fulfilling prophecies of bank failures. The SVB collapse offers crucial global lessons. First, it underscores the critical importance of risk management in banks. Diversification, hedging, and stress testing are not just buzzwords. They're essential practices that SVB largely ignored. Second, it highlights the delicate balance central banks must strike between controlling inflation and maintaining financial stability. Aggressive rate hikes may fight inflation, but can destabilize banks in the process. Lastly, it serves as a stark reminder that both regulators and depositors need to stay vigilant. Regulators must constantly monitor for systemic risks, while depositors should understand that even seemingly safe banks can face liquidity crises. In conclusion, the SVB collapse reminds us that modern finance, despite all its technological advancements and sophisticated regulations, is still vulnerable to age-old problems. The same dynamics that caused bank runs in the 1930s can reappear in today's digital age, albeit at a much faster pace. This leaves us with some thought-provoking questions. Can bank runs ever be truly eliminated, or can they only be managed better? Implementing tighter regulation or leveraging digital monitoring enough to prevent future crises? We'd love to hear your thoughts on this. Do you think we're doomed to repeat history, or can we innovate our way out of these financial vulnerabilities? Share your opinion in the comments below. Your insights not only help us create better content, but also contribute to a broader understanding of these complex financial issues. Thanks for watching, and we'll see you in the next video where we continue to unpack the economy, one topic at a time.